Yes, good afternoon once again. We have taken long, but we have to come back to our lesson and move on. Sorry for the long time, but the last time we met, we were looking at extraction of ledgers. We prepare them, and then after preparing the ledgers, we balance them down and extract a trial balance. We said and we know very well, by the time any business prepares a trial balance, it is now looking at how to prepare an income statement. So because all the information you need is already in the trial balance, the majority of the information, though there are others that may be in the adjustments, and those ones we shall see how to deal with them when time comes. Now today we are going to focus on preparation of income statements. Now we know very well that after the preparation of ledger, the next step for the business is to prepare an income statement. Others will call it statement of comprehensive income. So depending at the level, at universities they can call it statement of comprehensive income. At secondary or even at the universities, there has no problem. It can also be called income statement. So what is an income statement? Now this income statement, that statement prepared by businesses to know how much amount of income in terms of profit that they have made. And this one will let them know that they either have made a net loss or they have made a net profit. And if it is a net loss, what could have been the problem? And if it was a net profit, how did they do it and what should they need to do to continue the same? And we know very well that every business, most of the businesses are looking at profits, except businesses which are owned by the government. Their objective is not profit. But individuals who get money and put in business, they are looking at making profits, and therefore you cannot avoid that. So we have here an example, as you can see it. And this one says, the following information relates to the business of Blue Star Trading Company for the year ended 30th June 2019. So you can see all the items which are there. A trial balance always has debit side and credit side. Before we go ahead, you have to know that in a trial balance, having a debit and credit side, on the debit side, we are going to put there assets, expenses, losses. When we go on the credit side, we shall always have their incomes, profits, and possibly reserves. But when we are picking this from the trial balance, from the ledgers, you have to see on which side of the ledger is the balance brought down. If the balance brought down is on the debit side, then you are going to pick that from the ledger and you write the ledger name, say capital, you balance on the credit side, and you put it on the credit side of the trial balance. Purchases always are on the debit side of the ledger, so we shall also put them on the debit side of the trial balance. Now you can see from this question where we have stock, the figures are there, sales, the figures are there, purchases, figures are there, wages and salaries, we have audit fees, we have rent and rent, we have insurance, we have general expenses, premises, motor van, debtors, creditors, bank, cash, drawings, capital, and electricity. Later we are seeing a total of both sides 38,300,000. So it means that the ledgers were right in most cases. But it is not always true that when the trial balance comes out, it means that the ledgers are right. No. We have some errors which can be committed when you are preparing the ledgers, and you can extract the trial balance, and the trial balance comes out properly. Then we have also errors which cannot be disclosed. And those ones, when you prepare trial balance, it will always balance, though there were some errors. We have those errors which will be disclosed by the disagreement of the trial balance. And some of the errors which we will commit and the trial balance still agrees. We have errors of commission, errors of omission, errors of complete reversal, errors of principle, all those ones, plus very many others. But we have also errors which, when you commit them, the trial balance will not agree, like errors of wrong additions, errors due to poor subtractions, when you leave out a particular balance, things of that nature, the trial balance will not do what? Agree. So let us go ahead and see. So when you look in our work, they are telling us that this business of Blue Star Trading Company had all those items, but at the end of the day, they had closing stock, and this closing stock is valued at 1,430,000. 1,430,000. What is the closing stock? When you are trading, when you are involved in business, and the year has come to end, can be 12 months, or a fiscal year, which is always 12 months. On the last date of the 12th month, which is possible, let's say it is December 31st, it does not, you are not going to sell each and everything. There are some goods which are going to remain in the business unsold. And those goods that remain in the business unsold are the ones we are calling as closing stock. Now, when you begin tomorrow, January 1 or 1st, again they are going to be opening stock for the new year, because you are the ones you are going to begin with to continue your business. And therefore, it is closing stock when the year is ending, and it becomes opening stock when the year is beginning. So we can see them there. And this always closing stock is not reflected anywhere in the trial balance when you are preparing trial balance. There will always be an adjustment, or what we call additional information, or additional notes down. And that's why we see them there. Now, when we look at this, we can see our question, the way we are preparing income statement. Now, when we prepare an income statement, there are certain principles we follow. And when you look at this work, that's how we are going to write an income statement heading. It will show the first one is going to be the name of the business. Which business are you preparing for the income statement? And here we say Blue Star Trading Company. Then what are you preparing? In this case, we are preparing an income statement, which I said others will call it statement of comprehensive income. When are you preparing that? That's why we say that for the year ended 30th June 2019. For the income statement, we don't say as at, which I'll always say for the year ended or for the year ending. And that is how it is. Now, we begin with the sales. We saw that the sales, these are goods sold by the business to make a profit. You are selling them because you want to make what? A profit. And therefore, we have sales as the first incomes. That's why we are going to have those columns as we see them. Now, we are beginning with the simple question from the known as we go to complex questions. Then beginning with the complex questions, and then we come to things which will get discourage people. So that's why we have to move slowly by slowly. And when we master them, we go to more complicated questions, and we see how do we come or how do we tackle these questions. And that's why we are moving like that. Now, when we go in the question, we had the sales. So sales are incomes, and therefore you're going to put them in the last column, like the way you can see them. Sorry for the interruption. Then after we have got sales, in this question, there were nothing like sales returns or purchase or returns inwards. What do we mean by sales returns or returns inwards? Those are goods that have been returned to the business by our customers, and therefore they are going to reduce on the amount of sales. But in this case, they are not there. So it means therefore in the whole question we don't have any adjustments. That's why we are not having a third column. And if we have adjustments, we shall have either 2 columns or 3 columns to see how do we calculate them. Therefore here we have sales, and sales will be put on the correct side, which is 28,400,000. Then from there we shall say less cost of sales. Cost of sales. Now when you go back at your mathematics that you did either at primary or level, at lower level, you were buying goods, they were giving you calculate the gross profit. And for you to get a gross profit, you are getting selling price minus cost price. Selling price is the price at which you have sold an item. And the cost price is the price at which you bought that item. For example, if you are dealing in shoes, and you bought shoes at 20,000, and you are selling them at 25,000. So the 20,000 is what we call cost price, and the 25,000 is the selling price. Therefore, in this case, sales, that is what will be the selling price. And the cost price is the price at which you bought it. That's why I say that's cost of sales. For us to get what we call as gross profit. And therefore, when we go back to our question, we shall say sales on the side that we see. Remember, this is not an account that we don't have there debit or credit. It's not an account. It's just a statement. So we shall have sales 28,400,000. Then we shall come and say less cost of sales, and we shall say opening stock. These are the goods that you have in the business as the year begins or when the financial period begins. Opening stock was 600,000. We are picking these figures from the trial balance. As you can see, item number 1 is an opening stock. Is stock. That stock you see there, though we are not having there the statement of opening stock, but it's the stock that we have as the start of the business. And it is the opening stock. The one we see in the trial balance is the opening stock. From there we shall add on purchases. These are goods that you have bought to come and put in the business for you to sell and get a profit. Therefore, when we get opening stock, those goods you have in the business and you add on what we call purchases, we shall get in this case 600,000 plus 14 million, we shall get 14,600,000. That is the cost of goods available for sale. That is now the price of all goods you have in your business that you are going to sell in that particular period. That's what we mean by 14,600,000. Those goods that you have now in your business or in your store that you are going to sell. But when you sell these goods and you get the sales of 28,400,000, when the year ends, there are certain goods that you have not sold. Remember, 14 is now like the cost because you buy goods at a lower price, aiming at selling them at a higher price. That's why you see sales being a higher price. Now we are saying there are certain goods that you have not yet sold. Those ones remain as closing stock. Therefore, you are going to get the cost of goods available for sale minus closing stock. That's why I say less closing stock. That's the goods. Those are the goods that you have remained with in the business that you have not sold. Therefore, these goods, as you see them, we must minus and we see what actually in total did we save and how much did we get. What we got is 28 something. Therefore, we shall get the cost of goods available for sale of 14,600,000 minus, or say less closing stock of 1,430,000. When you look at the trial balance below, we have this figure of that 1,430,000, but down after preparing the trial balance. Therefore, when we minus 600,000 minus 1,430,000, we shall get 13,170,000. That one now represents cost of goods sold or cost of sales. Cost of goods sold or cost of sales, they are the same things. And you can see that when you go back to our question, it is saying that sales minus cost of sales. Sales minus cost of sales. That's why you see that the cost of goods sold, which are our cost of sales, are now in the last column below the sales. Up we have 28,400,000 as sales. Down we have 13,170,000 as cost of sales. And the question says sales minus cost of sales. That formula gives us a figure of gross profit. Therefore, 28,400,000 minus 13,170,000, we shall get 15,230,000. That figure represents our gross profit. So that is the profit you have got in the business before deducting any expense, and therefore you cannot take it as your profit. You have to remove the operating expenses. Now, after you have got our gross profit, we shall now come and say less operating expenses. What are operating expenses? These are expenses you incur when you are running a business. For example, there are many, though the question has a few. We are going to have very many. We have electricity, we have insurance, we have rent and rent, we have audit fees, we have depreciation, because even the furniture you are using or motor vehicles you are using are depreciating. They are losing value. They are losing value. General expenses, salaries, wages, you are paying the workers you have. You see, all those ones, those are expenses you are going to incur. Therefore, as you incur these expenses, we have to remove them from the gross profit. And that's why we are saying now here that part from sales up to gross profit is what we call the trading part or the trading account. Though we are seeing the income statement, but here it can also be called the trading account, that part alone. So we are now having gross profit less operating expense. Now, what formula are we getting there? Gross profit less operating expenses, or gross profit minus operating expenses, we shall get net profit, which will be net profit. And we now continue. Among the operating expenses, we have salaries and wages. From the trial balance, you can see salaries and wages. It is the item number 4 of 2,100,000. We have audit fees, 1,500,000. We have rent and rent, 600,000. We have insurance, 1,200,000. We have general expenses of 1,300,000. Then down we have electricity of 400,000. These are the expenses that we have here. Not everything here is an expense. Therefore, we shall come here and say less operating expenses. Salaries and wages, 2,100,000. Audit fees, 1,500,000. Audit fees these are expenses you incur when you bring auditors to balance your books of accounts. That is the expense you are paying. The money you are paying them is what you are calling audit fees. We have rent and rents. You are renting premises. We are operating a business. So that is the expense. And this rent we see the next one is possibly you are having an account in the bank and they charge you some charges because of maintaining your bank account. So that's why we have rent and rents. We also have insurance. It's an expense because you are insuring your business or you are insuring your item, some of the items which relate to the business. Then we have general expenses, 1,300,000. Electricity, 400,000. Therefore, when we add all these items, 6 of them that we see in this question, we shall get what we call total operating expenses. That is for the whole year. We are adding the sum total. They are not for only 1 month, but for the whole year. Therefore, we shall get total operating expenses and put them in the last column. And we shall total, when we add those total, we are getting 7,100,000. But you can see this total is in the last column below the gross profit. But when you go back to our equation, is saying gross profit less operating expenses. And that's why we are getting operating expenses and putting them below the gross profit, like that they're in the same line. So below up we have 15,230,000 as a gross profit. Then below we have 7,100,000 as total operating expenses. But our formula says that the gross profit less or minus operating expenses. So we shall get 15,230,000 minus 7,100,000. And as you can see, that bold arrow is giving us the figure for net profit, which is 8,130,000. Therefore, that's what we call as net profit for the business. It means for the whole year, this Blue Star Trading Company made a net profit of 8,130,000, which is good. So this is now the profit the business can use to expand the business by buying more goods, even by opening up other branches. So it's now the profit the business has made at the end of the 12 months. That's one physical year, shown by that arrow. In exams, sorry for the check shaking. In exams, there is no need for you to show these arrows. It's not possible. Don't show them. I'm just putting them there for you to see the figures you are referring to. But in exams, there is no need for you to show them. Therefore, that's what we call an income statement. And as I told you at different levels, we call them statement of comprehensive incomes for the year ended 30th June 2019. We can continue. Now, when we finish preparation of income statement, the next step now is to prepare a balance sheet. A balance sheet. A balance sheet will also be in those 3 lines you see, but it is one heading in different lines. What is the name of the business? Blue Star Trading Company. What are you preparing? Balance sheet. When are you preparing it? As at 30th June. Now, this one here is not for the year, but it is for only one day at the end of the year. What do you have there? What is a balance sheet? A balance sheet, first of all, is that statement that shows the financial stand of a business at a given period of time. And it has assets, liabilities, and capital as their items. Therefore, it is a statement that shows the financial stand or position of a given business or even an individual at a given period of time. And that's how it looks like. Now, we shall prepare more balance sheets as we continue to see how it is prepared, how they are prepared. But the first thing we have in this one here, as I said, there are items we are going to get which may not be here, but we shall get them also as we move on. But we are beginning from the simple ones as we move on. The first thing we are going to get is fixed assets. Now, one thing you have to know, look at the units which have been applied. If the units are in shillings, indicate shillings. If they are in pounds, indicate pounds. If they are in dollars, indicate them as dollars. So that's how we are going to prepare them. Now, in most cases, we tend to prepare a balance sheet using the order of permanence. Though we have 2 orders, order of permanence and order of liquidity. Order of liquidity simply means that we begin with those items which can easily be used in the business quickly without staying. And the other way around comes to order of permanence, items which last in a long period of time in the business. For example, let us look at if you have cash, 20,000 in the pocket, and you have your house, which you can call buildings or premises. Which one can you dispose of quickly? 20,000 or the premises that you have? So you are going to dispose of, first of all, cash, and premises will lead the last. So when you prepare using the order of liquidity, we shall begin with the cash, then we come to premises. And if it is the order of permanence, we shall begin down with the premises, then the cash will come later. So we go, fixed assets. When you look at the fixed assets of this business, we have in our trial balance, you can see we have here premises and motor van. Those are the items which are here as fixed assets. Therefore, we shall also begin with them and put their premises as number 1, 2,500,000. Then motor van, 2,800,000. When we add their total, we get 5,300,000. And that becomes total fixed assets. We can also call them total non-current assets. It has no problem. Total non-current assets. It has no problem. It's the same thing. So here we are calling them total fixed assets. And the total fixed assets here in this case is 5,300,000. From there, we go to current assets. Current assets. Current assets, these are assets that you buy to be used in the business. In most cases, they don't go beyond 1 year before you use them. Whereas fixed assets, you buy them for you buy them to be used, but whereas this ones here are consumed actually. Current assets do not go beyond 1 year, whereas fixed assets, they go beyond 1 year. So when you come to current assets, we have stock of 1,430,000. And when you look at our question, you can see down here under adjustment, stock closing stock valued at 1,430,000 is what we are using. Not that one which is up in the trial balance. No, we are using this one which is down, and we should put it there as 1,430,000. We are not putting it in the last column where we have fixed assets. No, we put it in the second column. I told you there are times when you are going to have this having 3 columns. Then we go to debtors. These are our current assets. Who are debtors? Debtors are people who owes money to the business for the goods supplied. If somebody comes to your business and says, please give me those goods, I'm going to pay you money later. That person and you give him the goods without giving you money now, that person who has gone with the goods is the one you are calling as a debtor. He's a debtor. And you who has given him the goods, you are now a creditor because you are demanding. Therefore, we are going to say current assets, you have stock, we have put it there, debtors, 2 million. Then we go to cash at bank or just bank. And you can see when you look at our question, we have bank as item number 5 from down. We also have cash, item number 4 from down. All those 2 are current assets. We put them there. And then we get their total, it's not total assets, it's called total current assets, 10,830,000. But that one will be in that column. We don't put it in the last column still. Leave them there. From there we shall say we have total current assets here. I forgot to put it there. Less current liabilities. Less current liabilities. Now, the current liability, when you get total current assets minus current liabilities, we are aiming at getting working capital. That figure is total current assets. Remember, total current assets. I omitted the current. Is total current assets. So we have current assets minus current liabilities. We are going to get working capital. Now, when we go to current liabilities, we only have creditors. We have creditors, and you can see it from our question. It is item number 6 from down. From bank, as you go up, we have creditors, and that's why we have it there of 1,600,000. So we get current assets minus current liabilities to get working capital, 10,830,000 minus 1,300,000. So that figure of working capital, we shall put it in the last column where we have total fixed assets to be in the same line. To be in the same line. And our question says total fixed assets. Total fixed assets. Now here we are adding on working capital in that column. When we add those two, we shall get capital employed. So we are adding 5,300,000 plus 9,230,000 to get capital employed of 14,530,000. And we underline that with 2 lines to close that. From there we shall go and say financed by. Financed by. So financed by, we bring in capital. You can see capital, which is direct in the question. You can see capital item number 2 from down, or as you go up, or number 1 from down on the credit side, from down. Because in the column of credit, we have only 2 items. Actually, it's the second item, capital of 80,300,000. So that figure, we are adding on net profit. Net profit was got in the income statement of 8,130,000. We now add it there. And when we add capital plus net profit, we are getting 16,430,000. When from there we shall minus drawings of 1,900,000. 1,900,000. And you can see we are getting 14,530,000. You can see that is also capital employed. No, you can see that we have two capital employed which are the same. The figure you see above of 14,530,000 must be the same when you add with the same down here part of financed by of 14,530,000. You don't have to forge. This is a balance sheet. Remember, a balance sheet has assets and liabilities, and assets must be equal to liabilities, and that's why we drive again further and we say that assets equals to liabilities, and in liabilities we get now again liabilities plus capital. Capital is a special form of liability which we never get out of business unless the business has collapsed or has ended. And therefore, that's how we say assets equals liabilities. Therefore, the total of capital employed both must be the same. And you can see I'm showing them the two arrows. Those two figures must be the same. They must be the same. And if they are the same, you know you have got the income statement plus the balance sheet. And that's how the income statement and the balance sheet ends. That's how it looks like. Unless if you have any question to ask. But if you don't have, that now marks the end of the income statement. But like I said, we shall continue with more income statements to get complicated questions as we move on and see how do we calculate them and how do we treat them, such that people can see how these things come up. We are going to have questions of more adjustments, where we have depreciation, things of accruals, things of arrears, things of outstanding, things of unexpired, things of unused. All those ones there. And we see how do we treat them. So that is how our statement for today ends. I wish you success. And I wish you people to ask more questions about this. And we see how do we get this question. I think for today we can end there. I remain Okello Hatuba. For more inquiries, feel free to ask. Thank you very much.